Hi friends, in this module we will discuss on chapter 3, admission of a partner, question number 38 to question number 40. Before we move on to the question, if you haven't subscribed to this channel yet, please do subscribe so that you can get notified whenever new topics are posted on YouTube. Now let's move on to question number 38. A and B are in partnership, sharing profit and losses in the ratio of 3:1. So we have two partners here, A and B, and they are sharing profit and losses in the ratio 3:1. On 1st April 2018, they admitted C as a partner on following terms. So they have a new partner C, and there are few terms. C is to bring 1 lakh as his capital and 50,000 for goodwill, half of which is to be withdrawn by A and B. Okay, there is 1 lakh rupees bought in as capital, 50,000 as goodwill, and half of it will be withdrawn by the existing partners. That the value of land and building to be appreciated by 15% and of the stock and machinery and fixtures to be reduced by 7 and 5% respectively. That provisions for doubtful debts to be made at 5%. That 15,000 to be provided for unforeseen liability. That C is to be given 1/5 share and the profit sharing ratio between A and B to remain the same. That 11,000 to be received as commission, hence to be accounted for. Okay, the question also gives the balance sheet as on 31st March 2018. We have to give journal entries, ledger accounts, and balance sheet of the newly constituted firm. Okay, so we will start up with the journal entries. Okay, the first journal entry. The new partner is going to bring 1 lakh rupees capital and 50,000 rupees as goodwill. So let's journalize this first. The first journal entry is the new partner is bringing in cash. So bank account debit 1 lakh 50,000, 1 lakh for capital and 50,000 for goodwill. So to C's capital, one lakh, to goodwill 50,000. Okay, so now since there is goodwill of 50,000, this has to be distributed to all partners. So that is premium on goodwill, account debit, the amount is 50,000 to all partners in their sacrificing ratio. So to A's capital, to B's capital. What's the sacrificing ratio? It is 3:1 itself. So it's 37,500, 12,500. Then the question, the first point also says that the old partners withdrew half of the goodwill. So half of 37,500 and half of 12,500 is withdrawn. So let's put the journal entry for that. A's capital account debit, B's capital account debit to bank. Okay, now half of 37,500, it is 18,750. Half of 12,500, it is 6,250. Totaling this, it's going to be 25,000. Okay, so the next point, that the value of land and building to be appreciated by 15%. Okay, we have the existing value of land and building, which is 3,30,000. 15% of 3,30,000, it's going to be 49,500. And the stock and machinery and fixtures to be reduced by 7% and 5%. So we have the value of stock, which is 1,80,000. It has to be reduced by 7%. Machinery and fixtures has to be reduced by 5%. So the journal entry for this is land and building account. It's going to be appreciated by 15%, which is 49,500. The value of stock and machinery is to be reduced, so we are crediting it to stock, to machinery. It's 12,600 and 10,000. The balancing figure will go to revaluation account. So to revaluation account, 49,500 minus 12,600 minus 10,000, it's going to be 26,900. Then the next point says that provision for doubtful debts to be made at 5%. So book debts, it's 2 lakh, 5% of 2 lakh, it is 10,000. So we are going to make a provision for doubtful debt. Revaluation account, debit 10,000 to provision for doubtful debts 10,000. Then the third point, it says the fourth point, it says that 15,000 to be provided for unforeseen liability. 15,000 as unforeseen liability. So revaluation account, debit to unforeseen liability. $15,000. Now the next transaction says that that C is to be given 1/5 share, and the profit sharing ratio between A and B should remain the same, so it's fine. That 11,000 is to be received as commission, hence to be accounted for. So we have to do journal entry for accrued commission. Why accrued commission? Because the transaction says this money is not yet received, but we are recognizing the revenue that is coming in the form of commission. So accrued commission account debit 11,000 to revaluation account 11,000. Now we have to pass one more journal entry, that is the revaluation account balance to be transferred to partners capital account. We can pass this journal entry after preparing the revaluation account. So leave some space for your journal. So let's prepare revaluation account now. So revaluation account. So first thing is land and building. Value is appreciated. So land and building. It's 49,500. Then we have accrued commission, which is coming on the credit side, 11,000. So we wrote two credit items in revaluation account. Accrued commission is coming, and we have land and building which is getting appreciated to revaluation account. The other things which is depreciating, we will have to write on the debit side of revaluation account, which is stock, machinery. Then we have again on the debit side provision for doubtful debts. We have unforeseen liability. So these are the items that we have to write on the debit side. So we have stock, which is 12,600. We have machinery, which is 10,000. We have provision for doubtful debts, again 10,000. Unforeseen liability, we have 15,000. Now we need to find the balance of this. 49,500 plus 11,000, it is going to be 60,500. 60,500. Now the balancing figure, it is going to capital account. What's the amount? 60,500 minus 12,600 minus 10,000 minus 10,000 minus 15,000. It's going to be 12,900. This we have to distribute to old partners in their old profit sharing ratio, which is A is going to get 9,675 and B is going to get 3,225. Now we got the balances for revaluation account, which is 9675 and 3255. So we have left one journal entry. We will finish that journal entry as we got the balance for revaluation account. The journal entry is revaluation account, debit. The amount is 12,900. 12,900 to A's capital to B's capital. It is 9675 and 3225. Okay, so the journal is completed and revaluation account is also completed. Now we have to prepare partners capital account. So we need to see in the journal where all partners capital is impacted. So we have C's capital 1 lakh and goodwill 50,000. So we have a capital account mentioned here. We have A's capital and B's capital mentioned here. And we have again A's capital and B's capital mentioned here. So these are the, again on revaluation account, we have A's capital and B's capital. So wherever the capital account is mentioned, we have to post it to the ledger. So here there is partners capital account, partners A, B, C. Okay, the initial balance is given in the question. Initial balance is 4 lakhs, 2 lakhs. And then the new partner C is admitted, so bank 1 lakh. Then C is also bringing goodwill, which is transferred to old partner's capital account, so that is 37,500 and 12,500. Then the old partner is withdrawing half of their goodwill, so bank account on the debit side 18,750 and 6,250. Then we have revaluation account balances revaluation account 9675 and 3225. Now we need to find the final balances here. It is 4,47,175. Then we have B's balance here. It is 2,15,725 and C's balance is 1 lakh. It's going to be 4,47,175, 2,15,725 and 1 lakh. So the balancing figure here is 4,28,425. Here it is 2,09,475 and for C it is 1 lakh. So we completed partner's current capital account. It is actually capital account. Okay, now we will prepare the new balance sheet. Balance sheet, liabilities, assets. Okay, we should have a look at our old balance sheet. We have sundry creditors, capital, cash in hand, book debts, stock, machinery, etc. So cash in hand balance, it was 40,000 initially, correct? Cash in hand balance, it was 40,000. 40,000 is mentioned in the old balance sheet. From that date, we have few transactions that's happening. So one thing is 1,50,000 rupees we got in bank account. Okay, let's highlight it with the different color. So 1,50,000 we got it in bank balance sheet. So 40,000 plus 1,50,000. Then we withdrew 25,000. So 1,90,000 minus 25,000. It's going to be 1,65,000. Okay, so balance sheet, assets, bank, 1,65,000. Okay, the next one is book debts, 2 lakh. But again we have a provision here. Where is the provision? Provision for doubtful debts. So we need to adjust for the provision for doubtful debts on debtors, 2 lakhs. Okay, so it's going to be debtors 2 lakhs less provision for doubtful debts, that is 10,000. So it's going to be 1,90,000. Similarly, we have to do adjustment on stock. Stock value is depreciated. So the final value after depreciation is 1,67,400. Then we have machinery. After depreciation, the machinery value is 1,90,000. Then we have land and building. After appreciation, the value is 3,79,500. Then we have one more item, accrued commission. Which is 11,000. Then on the liability side, we have sundry creditors. No change from the old balance sheet. The value is 3,50,000. Then we have unforeseen liability, a new item from the adjustments, that is 15,000. Then we have the capital of A, B and C. Capital balances are mentioned here in the capital account, so we are going to take the same balances. For A it is 4,28,425. For B it is 2,09,475. For C it is 1 lakh. So the total is 7,37,900. Now let's total this up. The liability side it's 11,02,900, and asset side it is also 11,02,900. So balance sheet, assets and liabilities are matching. Now we completed question number 38. Let's move on to question number 39. Kushi and Sukshi are partners in a firm sharing profits in the ratio of 5:4. On April 1, 2016, they admitted Muskan as a new partner, and the new ratio is agreed at 3:2:1. On that date, there was a balance of 63,000 in profit and loss account and a balance of 45,000 in general reserve. Record necessary journal entries. So here we have two partners, Kushi and Suki. Their profit sharing ratio is 5:4. They admitted a new partner, Muskan. And after admission, the new profit sharing ratio became 3:2:1. Before admitting the new partner, the balance sheet had the following items. The P&L account had a credit balance of 63,000. And we have a general reserve which is 45,000. So since these are on liability side, the journal entry to adjust this is going to be P&L account debit 63,000, general reserve account debit 45,000 to the old partners in their old profit sharing ratio. So it is Kushi's capital to Suki's capital. Old profit sharing ratio is 5:4. We have 5:4. So if you divide 63,000 plus 45,000, it is 1,08,000. 1,08,000 into 5/9, it's going to be 60,000. And 1,08,000 into 4/9, it's going to be 48,000. So that's a journal entry. Only one journal entry for this question. Okay, now let's move on to question number 40. A and B were partners in a firm sharing profits in the ratio of 7:3. So we have two partners here, A and B. They are sharing profits in the ratio of 7:3. They admitted a new partner, C, for 1/6 share of profit. They fix the new profit sharing ratio as 3:2:1. So we have A, B, C, their new profit sharing ratio is 3:2:1. The P&L account on this date of admission showed a balance of 20,000. So let's show a small balance sheet here. we have a P&L account. It is showing a balance of 20,000 credit, so it's on the liability side of the balance sheet. The firm also had a reserve of 1,50,000. Okay, we have a general reserve of 1,50,000. C is to bring 40,000 as premium for his share of goodwill. Okay, C has to bring 40,000 as goodwill. Showing your calculations clearly, pass necessary journal entries to record the above transaction. So we have an old profit sharing ratio which is 7:3, and we have a new profit sharing ratio which is 3:2:1. So we need to find the sacrificing ratio. So we are first going to find the sacrifice or gain ratio. For A, it is the initial share. His original share is 7:3. So that is 7/10 minus his new share, which is 3/6. This will give 12/60. So this is a sacrifice. Then we will move on to the next partner, B. His original share is 3/10. Okay, so that is 3/10 minus his new share, which is 2/6. That will give you 2/60. So here he is gaining. It's a gaining. It's a gain. He's gaining 2/60. C, he didn't have any share originally, and now he is getting new share 1/6. So it is equal to minus 10/60. Here also he is gaining. So we know that there are two partners who is gaining. C, the new partner who is getting admitted, he is gaining, as well as B, the old partner, is also gaining. So here B is also supposed to bring his share of goodwill. So let's calculate the goodwill. So goodwill of the firm, we need to calculate the goodwill of the firm. For 1/6 share of goodwill, C is bringing 40,000 as goodwill, right? So we need to calculate the goodwill of the firm, which is equal to 40,000 multiplied by 6/1. That is equal to 2,40,000. Now we wanted to understand how much B should bring us his share of goodwill. So B's goodwill is, his gain is 2/60. So goodwill of the firm 2,40,000 multiplied by 2/60. That's equal to 8,000. So since B is gaining, he should bring 8,000 along with C, who is bringing 40,000 as goodwill. So let's pass the journal entry. First thing, bank account, debit 40,000. C is bringing 40,000 as goodwill. Bank account debit 40,000 to premium on goodwill 40,000. So whatever premium on goodwill is bought, it has to be given to sacrificing partner. So premium on goodwill account debit 40,000. Here C is not the only one who should bring goodwill. C is bringing goodwill, and along with C, B also has to bring 8,000 as goodwill. Since he is not bringing it in cash, we are going to debit his capital account. So B's capital account debit 8,000. 2. Everything will go to the sacrificing partner, in this case AS capital account. 48,000. Now we need to also understand that at the time of the admission, the balance sheet had a P&L account balance of 20,000 and a general reserve balance of 1,50,000. So this has to be distributed to old partners in the old profit sharing ratio. So the journal entry for that is P&L account debit 20,000, general reserve account debit 1,50,000. This has to be distributed to old partners, to A's capital, to B's capital in their old profit sharing ratio, which is 7:3. So 1,70,000 into 7 by 10, it is 1,19,000 and 51,000. Only 3 journal entries for this question. So we completed question number 40. So friends, if you haven't subscribed the channel, please do subscribe the channel so that you don't miss out on further questions. Thank you.